Welcome to Trading an Edge, the podcast where we break down the psychology, mindset, and system of elite trading. Today, we're taking a deep dive into something that, honestly, many traders overlook, often, really to their detriment, but it's absolutely crucial for sustained success. We're talking about the trader's feedback loop. You might instinctively think, I'm losing money because my strategy's flawed, or the market's just bad, or maybe even just bad luck. But here's where it gets really interesting and maybe a bit disruptive. Most traders aren't actually losing because their strategies are inherently bad. No, they're losing because they never rigorously track what they actually do. There's no objective journal, no systematic feedback, and so no real measurable improvement. It's a truth that can feel uncomfortable, I get it, but it's foundational if you want to become a truly elite trader.
Precisely. And what we're exploring today is how disciplined journaling and, importantly, structured review don't just help your trading. They literally become the engine that builds, refines, and protects your edge in the market. Think about your trades not as these isolated events, win or lose, but as critical data points. Seriously, data points. Without a robust, an intelligent feedback loop, that continuous cycle of plan, then execute, then critically review, you are effectively flying blind. Journaling is what transforms what feels like just random chaotic outcomes into measurable, actionable patterns. And it's these patterns, along with your sort of clinical insight into them, that lead to an evolving, resilient edge, one that can stand the test of time and, market volatility. This isn't just about jotting things down. It's about deep analytical, almost clinical insight into your own performance.
Right. So what does this all mean for you listening right now? If you're serious about trading, think of it this way. A trader trying to navigate the markets without a comprehensive, data-driven journal. It's like a pilot trying to fly through complex airspace without an instrument panel. Yeah, you might feel in control for a bit, maybe you're relying on gut instinct or it's just been sunny skies, but inevitably, you're going to fly straight into a storm you never saw coming. Why? Because you lacked the objective data to navigate it. So today we're going to unpack how you arm yourself with those essential instruments, not just for survival, but for consistent, profitable flight.
Yeah, and if we connect this to the bigger picture, trading is often profoundly misunderstood if people just see it as like a series of individual bets. It's not that. It's a continuous cyclical process. It's plan, then execute, then review, always. The trade journal. It isn't some optional add-on, some nice to have. It is the central, indispensable tool that closes this loop. It's what makes true, actionable learning even possible. And this raises a really important, almost existential question for a lot of traders. How do you truly know if a winning trade was because of your skill or just pure dumb luck? And just as importantly, how do you genuinely learn from a losing trade if you don't objectively understand why it happened? Wins and losses, you see, they're often profoundly deceptive. You might execute a perfect textbook good trade, followed your plan to the letter, only for some unexpected market condition to shift against you, and boom, it's a loss. Conversely, a bad trade, maybe one where you totally deviated from your rules, might just stumble into profit purely by chance. Now, without consciously, rigorously separating your process, the decisions you made, the rules you followed or broke, from the outcome, the P&L, you're in trouble. You'll inevitably start reinforcing the wrong behaviors, chasing those lucky wins from bad habits, ignoring valuable lessons from unlucky but well-executed losses. And over time, this just erodes and ultimately destroys your edge. A data-driven journal lets you objectively evaluate your process. And that's the only thing truly within your control, and it's the only reliable path to consistent improvement.
That's a huge insight because I know so many traders, when things are good, they think they're geniuses, right? And then when things turn bad, suddenly it's the market's fault or their broker or anything but their own execution. Okay, let's unpack the difference here because lots of traders do keep what they might call a trading diary. Often it's just a simple log. Entry, exit, maybe a quick note on the P&L. Sure, it tells you what happened, but it offers very little actionable insight into why it happened or, crucially, how to improve. We're talking about something totally different here, a data-driven journal. This is a systematic, almost forensic collection of very specific data points on every single trade you take. It's really the difference between just recounting events and building a scientific database for rigorous analysis. This is what lets you truly identify patterns, understand the root causes of your successes and failures, and fundamentally helps you refine and sharpen that edge. But why do you think so many traders resist this? It seems so obviously beneficial, yet it's often the first thing to go when they get busy or discouraged.
Yeah, that's a really perceptive question, and it often comes down to, well, a pretty profound psychological barrier. It's ego, and maybe a fear of confronting uncomfortable truths. Let's be honest. Nobody wants to see their mistakes laid bare, right? their inconsistencies, their emotional triggers. It feels like judging yourself. So traders often perceive journaling as just a time sink, or worse, a tool that's just going to highlight their shortcomings. But the journal isn't about judgment. It's a cold, hard, objective mirror. It reflects patterns your conscious mind might be desperately trying to ignore. Patterns of overconfidence after a win, maybe loss aversion causing early exits, revenge trading after a loss, even subtle forms of self-sabotage. Things that no amount of strategy backtesting is ever going to reveal. Journaling combats that illusion of control by showing you what you're really doing, not just what you think you're doing. Yes, it's uncomfortable, but it's vital. Okay, I'm sold. So if we're ready to face that mirror, what exactly needs to go into this data-driven journal? What are the absolute essentials for every trade? Right. What's fascinating here, and really crucial, is that for every single trade, you need to capture two distinct but equally critical types of information. We often call them the hard facts and the soft facts. These two pillars, quantitative data and qualitative data, they combine to give you the most comprehensive picture possible of your trading performance. Get one without the other, and your insights, they'll always be incomplete.
Makes sense. Let's start with those hard facts then, the quantitative stuff. These are your market-facing facts, right? The measurable, undeniable elements of the trade that don't lie. These are the things you absolutely must log every single time. First, date and time, both entry and exit, down to the minute if possible. You need to know precisely when it happened. Second, the instrument. What did you trade? URUSD, GBP USD, Apple stock, whatever it is, be specific. Next, the direction. Simple. Was it long or short? Then, your exact entry price and exit price. The actual numbers. No fudging, critically important. Your risk per trade. Before you even enter, what was the fixed dollar amount or percentage you planned to risk? Then, position size. How many units, contracts, shares? How large was the trade? Also, your stop loss and take profit levels, both your initial plan levels and, very importantly, any levels you adjusted to during the trade. And finally, the obvious one, but still crucial, your final P&L. The actual profit or loss in dollars or pounds or whatever your account currency is. These are the nuts and bolts, the raw data points. It sounds like a bit of work, maybe, but consistency here is absolutely key.
Absolutely. While those hard facts are essential, the skeleton, if you will, the real transformative power, often comes from the soft facts, the quantitative side. This is where the deep psychology really comes in, the human element behind your decisions. This often reveals the true underlying drivers of your performance, the why behind the numbers. This is where you connect that objective trade data with your subjective inner world. You really need to capture this stuff. First, your trade rationale. Simple question: why did you take this trade? How did it align with your predefined trading plan? For example, was it price broke key resistance on the 1-hour chart, confirming my breakout setup? Or was it more like, saw a quick scalp opportunity on the 5-in chart, felt kind of impulsive? Documenting this helps you see if you're executing your plan or just reacting emotionally. Second, your psychological state. This is vital. What was your emotional state before the trade, during it, and after it? Be brutally honest with yourself here. Were you feeling confident but maybe a bit rushed on entry because of FOMO? Or maybe anxious after that first loss of the day, which led me to over-leverage on the next trade? Or perhaps I was calm and focused throughout, executed without hesitation. Recognizing these states, it's a game changer. Third, and maybe the most crucial bit, your plan adherence. Did you follow your trading plan perfectly? Yes or no? If not, where specifically and why did you deviate? This is where true self-awareness starts to blossom. You might find yourself writing, held the trade way too long because of greed, ignored my TP level, or maybe cut the winner too early due to fear, even though the setup was still perfectly valid. This distinction, adhering to process versus deviating, is absolutely the core of process-based improvement. And finally, just notes and observations. Any other thoughts, anything about the broader market context that influenced you? Like, oh yeah, CPI data came out mid-trade, or market felt really choppy after the Fed announcement, or maybe just specific lessons you learned right in that moment. This qualitative data is pure gold for self-improvement. It brings the cold, hard numbers to life with the human story of your trading.
That's a fantastic distinction. Yeah, it's like the hard data tells you what happened and the soft data really tells you why. But as you said, simply logging all this data, no matter how detailed, well, it isn't enough, is it? It's just raw material sitting there. The true power, the actual transformation, comes from a structured, disciplined review process. So let's talk about that. We've got a clear step-by-step framework for you listening to turn that raw data into genuine, actionable insight. It's about more than just looking at your numbers, it's about really interrogating them.
Exactly. And this framework is specifically designed to move you from just observing to understanding deeply, and then, most importantly, to taking decisive action. So step 1, or maybe we call the initial logging step 1 and 2. Let's call this step 3, the daily check-in. Immediately after you finish trading for the day, or maybe even after each significant trade, if that works better for you, while the emotions and thoughts are still fresh, do a brief, honest review of each trade. Log all those hard and soft data points we just covered. The goal here is immediate capture. Don't let your feelings or the details fade. This initial capture is about getting that raw, unfiltered insight into your state and your decisions right in the moment. Think of it like immediate flight recordings after a crucial maneuver. Then, step 4, weekly pattern analysis. This is where the real deep dive begins. Over the weekend, you need to set aside dedicated time, no distractions. Analyze the previous week's trades as a collective group. This is where you move beyond individual trades and start identifying recurring patterns in your data. Ask yourself some hard questions. What was my overall win rate and profitability for the week? Did I have a higher win rate on a specific day, say Tuesdays? Or during a particular time, like the London Open? What was the most common reason for my losses? Was it a specific setup, failing repeatedly? Or was it me consistently breaking a particular rule? Where did I deviate from my trading plan most often? And what was the emotional context around those deviations? What triggers were most prevalent? For instance, did I consistently overtrade after taking even just a small loss? This weekly analysis helps you see the forest, not just the individual trees. It highlights your dominant habits, good and bad. Okay, step 5, monthly strategic review. Now, at the end of each month, it's time to step back even further. Get that bird's eye view. Analyze your overall performance against your expectations and your goals for the entire month. Use all that accumulated daily and weekly data to spot the larger overarching trends in your trading. This is where you make precise, systematic adjustments to your trading plan for the next month. Maybe your weekly reviews showed you're great in trending markets but consistently lose money when things get choppy. Your monthly review might lead you to formalize a new rule.
Maybe significantly reduce your position size, or even just sit out completely when you identify range-bound market conditions. Remember, the goal here isn't to judge your past actions with regret. It's to clinically refine your approach for the future. It's about strategic evolution, not beating yourself up.
Right. So we've gone from capturing immediate details to seeing those weekly patterns emerge. And now this big picture monthly strategic overhaul. It sounds like you're not just getting flight instruments. You're basically building your own flight simulator, constantly refining both the aircraft, your strategy, and the pilot yourself. But, and this feels like the most important part, all this data, all this review, it's pretty useless if you don't actually do anything with it, right? What's the final critical step in making this whole thing work?
You've absolutely hit the crux of it. That leads us to step 6, turn insights into action. Look, data without systematic review is just noise. And review without concrete measurable action, that's just wasted time. Or maybe even worse, it breeds complacency because you feel like you're doing something productive. The ultimate purpose, the entire point of this journaling and review process is to move from simple awareness to actual concrete behavioral change. This means actively. First, identifying your strengths. Discovering, through your own objective data, that your strategy consistently works best on, say, USD, or maybe only in strong trending conditions, or perhaps just during the first 2 hours of the New York session. You might find your setups during the London Open are exceptionally high probability. This allows you to lean into what truly works for you. Double down on your strengths. Second, pinpointing weaknesses. This is often the most uncomfortable part, but probably the most valuable. Finding that you consistently hemorrhage money when trading in the first hour of the day, or that your success rate just plummets whenever you skip your pre-trade checklist, or that your biggest losses always happen when you try to counter trend trade. This precise identification allows you to either eliminate these scenarios entirely or develop very specific protocols to manage them much more effectively. Third, neutralizing emotional triggers. Recognizing perhaps that your chronic overtrading habit gets consistently triggered by just a single losing trade, or that you hesitate on perfectly good setups after a string of wins because you're afraid of giving back profits. The journal helps you identify these specific psychological vulnerabilities, and once you see them clearly, you can develop a specific protocol to handle that trigger next time it appears, breaking that destructive cycle. This might be something concrete, like a mandatory 15-minute break after any loss, no exceptions. Or maybe a defined maximum number of trades per day, period. And finally, most importantly, refining your edge. Systematically improving your strategy. Making precise adjustments to your entry criteria, maybe your exit rules, perhaps your risk management protocols, all based on objective data from your trading. Not gut feelings, not something you read on Twitter, not arbitrary decisions.
Clinical evidence from your own performance. For example, if your journal shows your stop loss is consistently getting tagged just before a strong reversal in your favor, Well, you might adjust your initial stop placement by just a few pips, or maybe decide to wait for one additional confirmation candle before entering. Or if your data clearly shows your best setups occur on Mondays and Wednesdays, you might consciously decide to reduce your trading frequency significantly on other days, conserving your precious mental capital for those higher probability moments. This is how you build a truly robust, durable, and crucially, an evolving trading framework.
So wrapping this up, what does this all mean for you, the listener? Trading can often feel like, well, like a chaotic dance with the markets, right? Maybe a game of pure luck where you just feel like you're at the mercy of external forces. But with this structured feedback loop, with this disciplined approach to journaling and review, it transforms. It becomes a scientific process of continuous improvement. You're not just a speculator anymore. You become a scientist, an analyst of your own performance. You start taking control where you actually can.
By diligently tracking, analyzing, and then acting on your process, you build a powerful, repeatable edge. An edge that's resilient both to shifting market conditions and, just as importantly, to your own internal emotional volatility. It really is the ultimate path to self-mastery in trading. But here's the provocation I want to leave you with. The journal is your mirror. It will show you exactly who you are as a trader, the good, the bad, the ugly, without judgment or embellishment. But the real question is, will you look at it long enough and honestly enough to truly change the trader staring back at you?
Trading an edge where psychology meets profitability.